Cari fan di questo canale, abbiamo di nuovo con noi Hanno Lustig, che avete avuto modo di apprezzare un paio di puntate fa, e un ritorno graditissimo, il professor John Cochrane, che è stato mio professore all'Università di Chicago, è stato ospite già diverse volte qui su questo canale. Lui parla italiano perché ha vissuto a Firenze, dove suo padre era professore di storia dell'arte, e anche Anno capisce l'italiano, però questa puntata sarà in inglese perché noi siamo globastardi ed essendo globalisti e bastardi parliamo anche inglese. Allora, il tema di questa puntata sarà un libro che John ha scritto insieme a Luis Garicano e Klaus Masuch. Allora, Klaus Masuch era un mio collega, lo conosco bene perché era un mio collega alla Banca Centrale Europea, era uno dei personaggi più in vista, insomma, uno degli scerpa, si direbbe, che conosceva quindi tutti i meccanismi, conosceva tutte le minuzie, tutti i vari meandri dei trattati, quindi era una persona che conosce quello che in inglese si chiama nuts and bolts dell'impianto l'impianto istituzionale della governance della moneta unica. Luis Garicano invece è un professore di economia. John oggi è un senior fellow alla Hoover Institution, prestigiosissima think tank americana che ospita personaggi del calibro di Niall Ferguson, che anche abbiamo avuto come ospite, Condoleezza Rice, H.R. McMaster, e John, tra l'altro, ha uno splendido podcast che si chiama Goodfellows. Vi raccomando, andatelo ad ascoltare, mettetelo tra i vostri favoriti perché è una chicca, ecco, è veramente per persone di un certo standing. Okay, let's switch to English. John, you wrote this book, Crisis Cycle, Challenges, Evolution, and the Future of Euro, as I said, with Luis Garicano and Klaus Masuch. It has been listed as one of the best books of the summer 2025 by the Financial Times. So it has had one of the most prestigious recognition. And give us an overview of the main issues that you treat in this book.
Okay. The euro is great. We are not skeptics of the euro. We like the idea of a currency union. The euro is a currency union without fiscal or political union, and that is possible. Lots of people say, oh, that can't happen. No, it can happen. It works fine. But in the end, if you have such a union, it must be possible for countries to default on their debt, just as companies default on their debt without leaving the zone. If General Motors defaults on its debt, it doesn't have to create new dollars. It defaults. People lose money. The way it is, you earn some return in the good times, you lose money in the bad times. Now, we put that off as far as we can, but that has to be possible. There is, in a currency union without fiscal and political union, there's a strong temptation to borrow too much money, spend it on your voters, and then say, oh, crisis, call up the ECB, boom, 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 and say, bail us out, print some money, and bail out our debt. And that's the central problem. The European monetary system was set up beautifully to deal with that problem. And when you look back to the 1990s, I'm really in awe because nobody was thinking about advanced country sovereign debt. Nobody was thinking about big banking crises. And yet they put together a pretty darn good system to deal with this problem. An independent central bank that has a single mandate, price stability, that is not going to buy government debt, a no bailout clause among the fiscal institutions of the different countries, Debt and deficit limits, so you won't get in trouble in the first place. They thought about this problem. They didn't solve every problem because, of course, when you're writing the prenup, you don't talk about everything. And so they left out a few things. They didn't say countries can default. They didn't put in a default mechanism. And most of all, they didn't tell bank regulators you must treat sovereign debts as risky. So to this day, sovereign debts are risk-free to banks. Therefore, banks are stuffed with sovereign debt. And if the sovereign defaults, all the banks go under. So the banks are hostages to sovereign default, one of the biggest problems in allowing sovereigns to restructure, to default if they have to, or for that to be you can't threaten sovereigns fix it or default because then all the banks go under. So then what happened? That was a pretty good system, and we'll figure it out. We'll fix things as things go along. I mean, the U.S. Constitution didn't write every single law in the federal code in 1790. We'll figure things out and amend it as it goes along. Well, France and Germany broke the debt and deficit limits. Then the financial crisis came. The ECB started bailing out and borrowing things. The sovereign debt crisis came. Yes, sovereigns might get in trouble. And more buying sovereign debts, whatever it takes. And, again, we're not even criticizing those decisions. When a crisis comes, you, me, Hanno, we're all going to bail out. You say no ahead of time because you don't want anyone to think you're going to bail out. But when the crisis comes, you're going to bail out. The failure was an institutional one, not to say, hey, we had to bail everybody out. Let's solve that problem so that we don't have to do it again. And so the ECB started buying more and more sovereign debts, and then quantitative easing came, and then the target 2 balances exploded, which Hanno explains beautifully in his recent paper. Unwittingly, the European Central Bank became a fiscal transfer mechanism. Quantitative easing turned out to be a way for Italy to issue its debt at overnight rates, not at the market rate, supported by the rest of the EU. So there's part of the big fiscal transfer, which if the voters of Europe ever find out about, there's going to be trouble to pay. Then along came COVID and the war and the recession. Boom, more huge sovereign borrowing. The transmission protection instrument, the ECB comes up with these lovely names for buying sovereign bonds to keep the spreads down. Where are we today? The ECB is stuffed with sovereign debt. I think no matter what officials may say, like Christine Lagarde's lovely, we're not here to close spreads, upon which spreads jumped. And she said, oh, wait, we are here to close spreads. I think markets all expect the ECB to jump in and keep any sovereign spread from rising. You're stuck with this perpetual bailout. The reforms, once you say the problem, you have a schedule of reforms, it's pretty obvious. One, the banks, we got to get sovereign debt in hands that can take risk. So banks have to hold diversified portfolios of sovereign debt if they hold any sovereign debt. But let's recognize sovereign debt's risky. Treat it just like corporate debt. We get along with corporate debt that goes bank. You need a mechanism for sovereign default, including sort of IMF-like help, so that sovereigns that are having trouble rolling over debt can put in place a credible plan to fix the underlying economy and get some help in the meantime. Those are 2 of the big things. And the ECB's got to get out of the business credibly of buying sovereign debt. So that's the short version of the reform plan, and let the euro prosper once it goes back to being a currency union without political and fiscal union.
Hanno, it's your turn to give us your view. Do you agree with this picture? Do you want to add anything that is relevant for understanding where we stand and where we should go?
I I think John summarized it beautifully. The original idea behind the euro as a project was a great one, and I think it's been successful to a large extent. So I would call myself a supporter of the euro as well. But we've ended up in a position now where effectively the eurozone has become a fiscal transfer scheme, as John explained, and that's highly problematic because in the long run, that jeopardizes the future of the euro. As John hinted at, once voters figure out what is going on, I think there will be a lot of resentment, and the result of that could be, I think, the end of the euro. And that would be a very bad outcome. I agree with John's analysis and the analysis that he lays out in his book with Klaus and with Luis. Essentially, what we need to end up with is a eurozone where sovereign governments can default on their debt, and it is not the job of the European Central Bank to make sure that spreads on sovereign bonds between different countries stay within a narrow range. Unfortunately, the ECB has now put itself in a position where it's constantly second guessing the bond market and rolling out all sorts of different programs to try and make sure that prices don't deviate too much in the bond market from where they think they should be. That has really bad consequences, especially in terms of incentives, right? If you're a politician, let's say in Belgium, and you realize that you can run larger government deficits without being punished by the bond market, then you will be tempted to do just that. And so what then happens is you end up in this vicious cycle where governments run bigger deficits. The ECB now has to intervene even more aggressively in the bond market, run a larger balance sheet. That in turn implies bigger transfers. This is what we talked about last time. And so it's just not a sustainable arrangement. As John explained, you can sort of see how we ended up here. Once you're dealing with a crisis, you're always tempted to arrange a bailout. We all understand that. I think Larry Summers once said that when you're in a foxhole, you don't think about moral hazard. And so I think that was very much the way the Eurozone sort of ended up where we are now. But clearly where we are now is sort of really suboptimal. And in the long run, I think jeopardizes the whole project.
Let me make two remarks on what you just said. The famous "whatever it takes" by Mario Draghi had in reality two legs. The one that is obvious and best known is the promise to purchase all debt issued by member countries of the monetary union. Okay, and that's what he did essentially. The other leg, though, is the condition it imposed on Italy to introduce a constitutional amendment to mandate a balanced fiscal budget, which the Italian government, in fact, did. And the parliament approved this constitutional amendment with a huge majority, never seen before and after in the history of the Italian Republic. Unfortunately, even when you write in the Constitution that the budget must be balanced, politicians find a way to overcome that prohibition. And so Mario Draghi was left with the with the task of holding, of putting a dam against the fiscal indiscipline, the fiscal profligacy of governments without any constraint. The other element that I want to bring to your attention is the European stability mechanism, because you said, rightfully so, that government must be warned that they can go bankrupt. But in that case, the European institution, in reality, it's not even a European institution, because the European stability mechanism is an intergovernmental institution. It's not an EU institution or a Euro area institution. It's something that has been agreed among all the governments except the Italian government, but we'll come to that maybe later. That's not the point. But what I'm trying to say is that now governments have been made aware that you need a bankruptcy threat, and they even instituted a mechanism to handle that bankruptcy without destroying the euro area. You think it would be enough? You think that's the way to go, or do you think that a hard bankruptcy, a hard government default is a better option?
So I'll start on this one. As you said, default has to be there as one branch of the tree. Otherwise, you're negotiating, knowing nothing will happen. Mario Draghi said whatever it takes, and he got away with it because he actually didn't have to do anything. The key of being a central bank is if you bring enough firepower, then they cave. And once now, lately, it's been taking more and more, so they've actually had to start buying. You only get away with whatever it takes once. But it's very important. This I learned writing the book. It was not, we'll buy whatever bonds. We will buy bonds along with an ESM conditionality program. So the way this works for your listeners is the European stability mechanism was created, and it can provide fiscal help, not newly printed money. It can provide money from the other fiscal authorities of Europe to help a government in trouble. The same way in bankruptcy, you have debtor in possession financing. You have you have a workaround where we'll help you, roll over your debt now in return for conditions, which are debt and deficit conditions, as you mentioned, but also microeconomic conditions. So let's remember the number one question is growth, both because Europe's growth is like the number one issue. None of this matters compared to growth. But growth is also the way out of fiscal problems, because if income grows, tax revenues grow, even without changing tax rates. So they, imposing microeconomic reforms and fiscal reforms was what they can do. Now, that was a good system, except I just visited the ESM. They haven't had anything to do since Mario Draghi. They're kind of sitting around twiddling their thumbs, waiting for the next crisis, except they don't have enough money to bail out France. So we'll see what happens in that one. Now, we're at the situation now, however, with the new programs, the transmission protection instrument doesn't have this conditionality. The ECB can just buy stuff. So Draghi was carefully limited in what he could do. He put in some rules which are now gone. Now, there's good and bad in this. The danger in this system is you do not want the ECB telling countries what to do politically. That's the advantage of farming this out to an ESM, which is an enhanced ESM, is something we call for. Because if it's the ECB writing letters to finance ministers saying you have to raise taxes, you have to cut your labor regulations, you have to cut your subsidies, those are deeply political things to do. And if the ECB is going to be an apolitical, technocratic institution, then that's that's not good for the ECB. And then the country says, well, we would love to keep giving you all the money in the world, but the awful ECB is forcing us to do this. Well, that really undermines, the apolitical nature of an ECB. So that's the advantage of having an ESM do it. Hanno.
Yeah, I agree with that. I think it is important that there's a separate institution that takes care of this, like the ESM. I'm a bit skeptical about whether the ESM will ever really be able to put binding guardrails and constraints on individual member countries. Ultimately, these are still fiscally sovereign countries, and they value that. We talked about this a little bit last time in the last podcast. Europeans are not Americans. I think it's going to be very hard for an Italian voter to accept that some bureaucrat in Brussels or wherever the ESM is located is going to put constraints on how much the Italian government can spend. And so I'm a bit more skeptical with regards to that. And so ultimately that brings me back to where John started, which is the importance of being willing to allow countries to ultimately default if they embark on a fiscally unsustainable trajectory. And again, the reason I say that is because so far I haven't seen any evidence that European institutions have really been able to constrain fiscal policy in member states, including Germany, as you pointed out in your introduction. So I think that would be my only footnote to what John said. But I largely agree with what he said. And then
let me agree with Hanno on this and making default easier. Get the banks out of the way.
yes,
So, so make default possible, and then and default is always restructuring anyway. It's not you don't get your money back;
yeah.
you get less of it back, and then that's just much more credible. I'd like to see some sort of IMF-like institution that maybe can help, but I agree with you. I don't think it's all going to be hunky-dory. And that institution has to be able to threaten default. If you don't do what we
Yes.
want, well then, screw you. It's default time.
It's a default, sovereign default, would spread to the banking sector, like during the Greek crisis. French and German banks got into trouble because they had piled up a huge amount of Greek debt. So one needs to separate the banking sector from the government bond markets. And in the book, you actually, John, make a proposal in that sense. What other proposal you think should be adopted by the EU governance framework?
And I'm sure Hanno will have lots of good ideas in this one. So there's lots of ways to do this. First of all, let's get rid of concentrated portfolios. Why do Greek banks hold Greek government debt? Italian banks hold Italian government debt. French banks hold French government debt. Well, there's a good reason because the Treasury secretaries and the financial regulators want to place their government debt, and they can tell their own banks, hey, Luigi, show up at the government bond auctions or else. So number one, even if it were just diversified, that would help a lot because then you don't have a concentrated position. So if your bank's holding a diversified portfolio of all EU debts, then one country going under doesn't pull the bank under. Second, financial regulators can say, hey, government debt, treat that as risky. You don't get to have zero capital against government debt. You got to treat it like corporate bonds. Then the banks will automatically, hold less government debt. Better yet, government debt could be in mutual funds. So, why is a bank holding government debt funded by deposits? Why not government debt goes into a mutual fund, which is held by pension funds, insurance companies, private investors, where it's a diversified portfolio. Italy goes under. Okay, we lost 10%, but we made a lot of interest along the way. That's not a crisis for us to lose that 10%. So get the debt in hands that can hold. And then there's Euro bonds and other proposals and so forth. But a European banking union would help too. So why, as Greek banks in Greece and German banks in Germany, if German banks can seamlessly offer services in Greece, then even if all the Greek banks go under, well, you got the German banks, so the system keeps going. Hanno, you must have 10 more fix the European financial system.
I completely agree with John. I think the reason we have banks is not for them to run huge levered government bond portfolios. There are lots of other institutional investors that can buy government bonds and that have a real demand for duration, like insurance companies, pension funds, So we don't really need Italian banks to load up on Italian government bonds, nor do we need German banks to load up on German government bonds. And that is, I think, the first thing that we'd have to address. Unfortunately, I think here actually the ECB has in some ways actually encouraged banks to load up on government bonds. The LTROs have been used to some extent by banks in the past to basically do a carry trade. So you get cheap financing from the ECB and then you buy Italian government bonds and you earn a nice spread. And
With
so
no
in a
risk
way,
weight, no capital.
and no risk weight, exactly. So you're basically being subsidized by taxpayers because you benefit from deposit insurance and by the ECB to do a carry trade, which is not something we want banks to do. We'd like our hedge fund to do that if we're investing in a hedge fund, but not a bank who benefits from deposit insurance, right? So I would say that in some sense, some of the ECB's policies have directly contributed to this problem of banks having huge portfolios of their own government bonds within the eurozone.
And that
I
was
said
intentional.
that was
The ECB,
intentional.
to get through the crisis, the ECB bought a lot of bonds and wanted to get the banks to buy the bonds. Oops, the bonds are too low of collateral. They're too low credit quality for the ECB to buy them. So it told the banks, hey, we'll give you money and you go buy the government bonds. And incidentally, you don't have to put any capital up. It's like and we all kind of know the bonds aren't going to default. So it's like an arbitrage opportunity for the bonds. You borrow at this incredibly low for the banks, borrow at the incredibly low risk-free rate, hold on to the government bonds, and you know that if a crisis comes, the ECB will support the government bonds. A one-way bet. And so of course they loaded up on them.
Yeah.
You guys also, Hanno did
That
a
spread
great
also
job.
on the Sorry, go ahead, John.
Hanno did a great job of uncovering how quantitative easing led to this to this loading up of government debt, kind of unintentionally, because it's the national central banks that hold that country's government debt. Hanno, explain this lovely one.
Yeah, so what happens within the Eurozone is that it's not the ECB in Frankfurt that actually buys Italian government bonds when the European Central Bank decides to do quantitative easing to expand its balance sheet. Instead, what happens is that it asks the Banca d'Italia in Rome, the Italian central bank, to go out and buy Italian government bonds. So they then hold these bonds on their balance sheet. And the way the income pooling arrangement works within the Euro system is that everything is pooled except the income that the national central banks get from the holdings of sovereign bonds. So the Italian central bank gets to keep that spread, as does the German central bank. But of course, for the Germans, it's not a great deal because they're buying back actually expensive securities, and so for them, it's arguably a bad deal. But for a periphery country, it's a good deal in some sense. So that's the way quantitative easing works within the Eurozone. It's quite different from the way it works in the dollar zone in the US.
In addition, it also affects depositors because they don't get any interest on their deposits, on their current account as they used to, because the banks don't need deposits. Actually, when a client when you want to open an account with a bank, they say, no, please go ahead. No, go and open it somewhere else, because the deposits clients, retail clients, have become a nuisance, for banks. So that's another additional
So they are able to just
side
get all the money
effect.
they get all the money they want from the ECB. They don't need
Yeah,
depositors.
exactly.
Yes, and
it's cheap. No, you don't have to deal with bank reports. You don't have to deal with people getting into the bank to ask for this and that.
Well, in EU, know
Payments
your
and so on and
customer
so forth.
regulations.
Yeah.
I'm sure the EU regulations on banks are something to admire.
Yeah, and actually, to Fabio's last point, I think it's an important point because Europeans are different from Americans in the sense that they save in deposits, like,
Hmm.
and so they're heavily reliant on deposits. I think stock market participation rates are much lower than in the U.S. if you compare the Eurozone to the US. And so, as you pointed out, European depositors have been getting really disastrous real returns on their savings for the past decade or so, and certainly ECB policy, I think, has contributed to that, as you point out. It's kind of surprising that this doesn't come up more, and I'm surprised by that because I think it is something important.
Because look at who advertises on papers and on TVs. Who pays for the publicity?
No,
Banks.
Vanguard
And so they
Vanguard's
don't have,
been
nobody has an interest to, point that out because that would upset, main
but come
clients,
now.
main,
Vanguard, for example, if Vanguard to sell in
advertising.
Italy, they have an advertising budget. So Vanguard, or Fidelity or any other large provider of low cost index funds, if they're allowed to operate, they have an advertising budget. You're not going to explain this just by lack of advertising budgets among portfolio managers. Some of it is certainly that you have defined benefit rather than contribution pensions. Lots of U.S. stock holding starts in your pension fund.
For
But I'm
sure.
curious that Italians don't. What my money's in Vanguard Total Market Index. Why isn't the average Italians in the same thing?
That's a good question. I can't say I know the answer. I have noticed in the past that index funds are actually quite a bit more expensive in Europe than in the US.
Yeah.
Yeah.
So I think the asset management industry, I think it's changing. Vanguard, as you pointed out, has entered actually the European market, and so it's becoming more competitive. But for the longest time, it was not very competitive, the asset management industry. It seemed like a great industry to be in Europe because you could charge 100 basis points for some index fund, which was much higher than the typical expense ratios you see in the US. So hopefully that's changing, and that'll bring about more
I know in
participation.
some countries, I think in Germany, you have to buy it through a bank because we wouldn't want you, all alone, in the free market. Well, the bank,
Oh,
there's 100 basis points when you walk in the door.
absolutely. And actually, I was trying to help one of my relatives just invest in an index fund, and the banker was doing everything possible to keep us from buying an index fund and was constantly trying to get us to buy some active fund and made it very hard to just buy an index fund actually. So I think the asset management industry in Europe is a bit behind when it comes to offering sort of cheap, reliable options for investing in stocks.
Well, it's
Yeah.
part of, I
Let
think,
me
one of the
ask
bigger
you.
problems. We don't have European financial union. We don't have European banking union. We don't
Yeah.
really have, we have a free market sort of in goods, but not in services,
Yeah.
and which is kind of the disaster. We're all economists. As of 1990, you say we get a free market and an integrated monetary union. We say, wow, watch Europe's growth take off. They'll pass the US. And instead we got stagnation. So, it's a real tragedy.
It is, and actually, there was a great piece in the Financial Times 2 days ago about a German baker. Sorry, excuse me, a French baker who was trying to open a bakery in Germany, and the roadblocks this guy had to jump over. It was just amazing. It was a process that took years, but eventually he succeeded. Had to take a bunch of exams because apparently the Germans have something that is like the medieval guilds even now, where
Oh yeah.
you want to be a baker, you kind of have to jump through a whole bunch of hoops.
We don't
Um,
want these French croissants around
yeah,
here.
we don't
Show
want
us
these
you can make
awful
us
croissants.
hodl.
Exactly. Yeah.
But I wanted to ask you two more questions. One is something that John and I spoke about when he gave a lecture at the University of Bologna. and is about inflation swaps. So I was suggesting, because this is one of my fixations, with old age, come this kind of behavior, that central bank, instead of using interest rates, they should use inflation swaps to handle, to manage their monetary policy. That's my first question. The other question is on gold reserves of the central bank, because this is a hot issue nowadays in Italy. And my question would be, can we use the gold reserves to finance the rearmament program in Europe? Would that be a good idea or not?
Okay,
Over to you.
I'll let you go first this time, Hanno.
Okay, so the inflation swap idea is a really intriguing idea, one that I've personally haven't thought about deeply. So you're suggesting that the central bank adjusts policy based on
Yeah, it
inflation
issues
swap.
inflation swaps at 1, 2, 3, 4, 10 years horizon. Point, you don't even need a central bank in a sense, because the government can be responsible for that liability, let's say, for that issuance. And
let me jump in here.
you promise that you would reimburse citizen for any deviation from an inflation target.
Let me jump in here, Fabio, because I wrote about this a little bit in fiscal theory. It's an idea I've been playing with. So I want to try it on Hanno, because if anyone can find the holes, it's going to be Hanno. So instead of the central bank targeting the level of the nominal rate and trying to guess where's R star, where's U star, up and down, why not target the spread between inflation indexed and non-indexed bonds? So target expected inflation. And let's just make that a target. Come and get it. If you want a 2% inflation target, we'll target this spread at 2%. And then the rest of the economy has to adjust to where expected inflation is 2%. Now, what can go wrong with this? I realize what it's pushing on heavily is the stability properties that we think in modern economics exist. So the old doctrine was an interest rate peg would lead to spiraling inflation. Now we believe, modern rational expectations models say an interest rate peg is stable. And the same, you got that would be the one objection, that if I peg the expected inflation, letting the nominal rate go wherever it was, then inflation, that's a steady state, but inflation might spiral away. So it trusts that the economy is stable. But with that stability, I kind of like the idea, target expected inflation, and then let the nominal rate go where it carries the same idea as the gold standard. The gold standard had a nice idea. We will target something nominal and something real, and then, the price level will have to settle down there. Now, the gold standard is terrible for all sorts of reasons, but why? And then people say, how about a commodity standard? Well, then what about the commodities? It ends up being a CPI standard. So we will target, the CPI via, and the difference between, so this inflation swaps is the same as the difference between the interest rate differential. So that was a fun idea that I haven't had enough faith of to really go public with it, but once you accept the stability, it kind of goes with the theory that higher interest rates mean higher inflation, because that's also stability. And if you say that out loud in public, well, I guess I just did say that out loud in public, you get pilloried. But that too is a long run property. Now, how long, what's the short run dynamics, so forth. But it is an intriguing idea to get out of the business of trying to set the just price.
Yeah, that is an intriguing idea, and it would relieve central banks of the need, as you said, to measure our star. That seems to be where they spend a lot of their time and energy now. And I'm a little frustrated with how they do that and how they interpret these measures of our star. I think often central banks are just looking at their own shadow when they measure this sort of long run equilibrium real rate. And they also seem reluctant to look at what the market tells them, because we do have inflation indexed bonds that are traded, and as you know, right now there's a big gap between what our star is selling them and what the bond market is telling them. The bond market is telling them that, at least in the US, that long-term real rates are much higher than they used to be. And the R-star measures are sending a different signal. So yeah, I'm very sympathetic to the idea that maybe we should get away from trying to measure R-star, at least in the way we've been doing this, because I don't think that that is working very well. My broader concern is, and maybe that even applies to the inflation swaps, but I have to think about it more, is that even when central bankers look at market-based measures, if they run huge balance sheets, I do think that to some extent they're always looking at their own shadow. I mean, the Eurozone we were just talking about is a great example, right? If you were to look at spreads as market signals in the Eurozone, well, then you're going to get probably a distorted picture of credit risk, of true credit risk for these governments.
This would require much deeper markets in inflation-linked bonds. Inflation swaps are sort of a niche product among banks, but you need the average Joe and Jane or Luigi and Paola to be going down to their bank and investing in.
I see. That's the idea. That makes sense. Yeah, that's an intriguing idea.
I'll answer your gold question. Holding gold reserves is silly. What is the 19th century? The Scrooge McDuck, Paperon de Paperoni's, big gold swimming pool is silly. But the gold is an asset. So if you get rid of an asset, you have to buy another asset, or you're not backing something else. So it's not a magic thing that can just go away and be used to buy something fun, like weapons for Ukraine would be great. But it's no different on your overall government balance sheet than raising taxes or selling some other asset. So it's not magic in that way, even though it's a silly asset.
No, it's not magic, but you have an asset that sits there with no for no useful purpose, because I don't think that the European Central Bank will ever need to defend the exchange rate of the euro like, I don't know, the Bank of Italy used to do before monetary union.
Assets have to equal liabilities. So if you get rid of that asset, you got to purchase some other asset. Now, an asset with a better rate of return, yeah, but you can't. If would you then say that all of the ECB's assets are pointless and we can just send them all to Ukraine and don't worry about backing the euro? That's not a good idea. Sending money to Ukraine is a great idea, but just let's recognize that that comes from somewhere.
Yeah, no, I agree with what John said. I actually don't have any deep insights into gold reserves. I do realize that there's a controversy recently in Italy about gold reserves and who's the proper owner of the gold reserves, right?
So is it?
Yeah, but that has been settled because, according to the treaty, the whatever treaty you want to call it now, that it has been, consolidated in this union treaty. Central bank reserves belong to the European system of central banks. So basically, their use is decided by the ECB in Frankfurt, by the governing council in Frankfurt, not by national central banks or national government. So on that point, I guess the controversy is futile.
I see. Okay.
Okay. I think that we covered a wide range of issues. Thank you very much for your kindness. Thank you very much from Alberto, who is launching his bid for becoming the mayor of Bologna, so he couldn't be with us. And I hope to have you again on this YouTube channel in the near future. Thanks once again, and we really appreciate your kindness.
Thanks.
Thank you, Fabio. Thank you, John. Ciao.
Bye.